Hello friends, welcome to my channel on Dynamics 365 F&O solutions. In continuation of my previous session, today's session is to know about the accounting in ERP. So in the previous session, I had shown a product receipt journal, and I said I'll get into the details of how to understand a product receipt journal through a separate accounting basics session. So this session is going to be on accounting basics, and the objective of this session is to make you understand what are the different types of transactions, accounting, and how they are implemented in F&O and so on. So now let me get into this presentation. This is not a walkthrough of FN application. It's a PPT session. And I hope this will be useful to you when you start analyzing the transactions in FNO, especially when you do a posting for a purchase order, sales order, and inventory transactions. Okay. Now, let me get into the slide in detail. Okay. So, as you see here, um, a financial transaction means anything you transact in a business and you want to account it, it is called a financial transaction. For example, when you want to buy a spare part like a brake cable, you contact a supplier and you book the order through a purchase order. You receive the spare part into your inventory and you pay them now the cash, or you pay it in later by using the credit. So if you look at this example, something comes in and something goes out. What is something comes in here is a spare part which is coming in. What does go out here? Cash goes out. So that's why a financial transaction involves two outcomes. Something comes in and something goes out for every transaction. Without that, a financial transaction is not complete. So that's the reason, okay, we have to record a financial transaction using a no standard procedure. What are the procedures? There are two types, okay, of recording a financial transaction. One is called the single entry accounting, and the other is called a double entry accounting. Okay. Now let's see what is meant by single entry and double entry a little more in detail. Okay. Now, as you see here, a, a single entry accounting is um, usually involved in a simple business, and that involves only one side of a transaction. What do you mean by that? You record what you spend or you record what you earn. That's it. Okay. So um, now, whereas in a double entry, what you do is you record two sides of a transaction. Every transaction has two sides. Whenever something comes in into business, something else must go out, or a new obligation is created. Okay, and in single entry, every transaction has either a debit or a credit. Okay, we don't record an okay um, what comes in. For example, um, we do not know what comes in when we buy a product. Okay, we only record whatever we spend or whatever we earn. Whereas in double entry, every transaction has two sides. One is the debit side, and the other is the credit side. The total of all debits in the accounts must always equal the total of all credits. This double entry now helps us as a built-in check for ensuring that the transaction is complete, it is fully transparent, and you know what you spend and what comes in when you spend. For example, when I buy a spare part, I spend money, I pay cash, cash goes out. Okay, this is called something goes out, and the spare part comes in. So, what does it mean? So I spend 100 rupees or $100, and then I get $100 worth of a spare part. So these are two sides of a transaction. So this is what is done in double entry. Whereas if you take a single entry, I will just now record, okay, I spent $100 for buying a spare parts. That's all. Okay. So what is this? How does it help? Single entry is no, good enough for small businesses or household expenses. Okay. But a double entry is needed for large or medium businesses that needs to comply with regulatory requirements. Okay. So, and what is the other benefits? So the double entry now provides higher accuracy and transparency in financial records. It also helps in detecting errors quickly, and it helps in maintaining a balanced book, and it gets as a picture of no, it gives us a detailed picture of the financial performance of a company. Okay. Now let me give an example of a single entry. For example, I buy 1 kg of sugar for $10. I pay cash and only record $10 as an expense. Okay, this is single entry. Now, in double entry, what I do is I buy 1 kg of sugar and I pay cash. Something goes out and increase its dollar value. That is sugar's value in the inventory, kitchen inventory. Okay, this is called something comes in. So ERP software follows double entry accounting. So now to understand why ERP now gives a offset account and a main account. Okay, um, the reason for that is to implement double entry. So that's the reason whenever you know set up your uh, accounts related pages in a purchase or posting uh, or GL account, general ledger, module of ERP or F&O, for example, you will always, be asked to give the main account and offset account. So that's what is meant. I That's what is meant. No, by double entry accounting. So we normally, have to provide a main account and offset account that will always be automatically no, posted whenever you do the related transactions. Okay. So now let me get into a few more information on what is the accounting basics. So here you see that accounting equation. So what is accounting equation? So any business should comply with a basic accounting equation called A equal to L plus SE. What is A? A is asset, and L is liability, and SE is stockholders' equity. So what does it mean? A means what the business owns. Okay. I own, my company owns a spare part. So that is called an asset. Okay. And liability, what the business owes. In my no spare part example, what the business owes means I owe $100 to the supplier who has supplied me the spare part. So I have not paid the supplier because I have a credit terms with him. So then it means I have a liability to pay the supplier $100 because I have already received the goods spare part into my a business and it is no stored in my inventory. And the next is stockholders equity. So, what is stockholders' equity? It is the owner's contribution. So, whenever we start a business, there is a no capital, okay, invested by the business owner. That's called the owner's contribution. Okay. Now, the next dimension to the accounting equation here is the left side and the right side. What is left side? Left side is the assets. Okay. Always remember that when I say left side, it is the left side of the equation. Here you see only the asset. Okay. So that's why asset is the always mentioned as left side. And what is on the right side? On the right side of the equation, you see the liability and the stockholders' equity. So whenever we we use the asset account, we put it on the left side. Whenever we now use a liability account or a stockholders equity account, we put it on the right side, meaning we debit an asset account and we credit a liability and stockholders equity account as a default step. Okay. So a debit and credit have a different meaning in accounting equation. What does it mean? In accounting equation, debit here does not mean reducing the no value of this account type. And similarly, credit does not mean increasing, okay, um, the account's value. It just denotes left side and right side. Okay. So left side entry means debit the related account. And what do you do that? Why do you do that? If you want to increase the value of the left side account, you should debit it. For example, if I have to increase the value of my inventory because I have purchased a spare part called brake cable and I am now receiving it in my inventory. So what happens? My inventory is an example of an asset account. Okay, because it's an asset. I'm going to now sell it later on, but now it is an asset to me, and my asset value has gone up when I bring in a new now asset into my inventory. So in order to increase, I use the debit side of asset accounting. And similarly, for increasing the right side, I credit it. So when I want to increase the value of a liability or stakeholders equity, I credit the account, and when I want to increase an asset account, I debit the account. So this is a very important concept, so that this will be very useful when you start understanding the F&O transactions and vouchers. Okay, so please now try remember this. This is going to be useful down the line when we are going to get into the postings um, of purchase order and sales order and so on. Okay. Now let me give a few more dimensions of accounting basic. What is an account type and on what category does it fall? So these are all the account types which we are going to come across in F&O. Okay, basically they are asset account, asset types of account, liability types of account, equity, revenue, and expense. Okay, and what category does they fall in? An asset is part of the balance sheet account. Okay, and a liability is part of the balance sheet category, and equity is also part of the balance sheet. So, what is revenue? Revenue means it is part of the profit and loss operation statement of operations or income statement. Okay, now, what is an example of revenue? Okay, I sell this spare part to a customer. So what I do, I get some revenue. I buy it for 100, I sell it for 120 bucks. So when I sell, I record that transaction under a revenue account. So that's why it is called revenue, and that comes part of the profit and loss and income or income statement category. And expense. So expense is also part of the profit and loss and income statement category. So what's an expense? When I pay a rent, it's an expense. Okay. So when I owe some money to a vendor, it becomes a liability. Okay. When I get increase my inventory, it is an asset account. So equity, as I mentioned, it is a contribution by the business owner. Okay. So this is how we should remember, okay, the categories and the types of accounts. So because these are going to be, uh, quite common when we start seeing the transactions and when you start seeing the F&O reports. Okay. And let me move on. Now, how do we increase or decrease the value of various account types? Okay. Now, uh, whenever we want to increase the asset, we have to debit it. When we want to decrease the asset, we have to credit it. When we have to, okay, increase the expense account, we have to debit it. And we have to, when we have to reduce it, we have to credit it. Similarly, for revenue, when we want to increase the revenue account, we have to, credit it. And when we have to reduce the revenue account, we have to debit it. And liabilities, when we have to increase the liabilities, we have to credit it. And when we have to reduce the liabilities, we have to debit it. So equity is also, please note equity is on the right side. So um, like liabilities, equity, when we have to increase it, we have to credit it. And when we have to reduce it, we have to debit it. So please remember, this will be quite useful to now. You're not going to do it, you're not going to implement it manually, but please understand that this will help you understand the postings when you see the vouchers in F&O. Okay. Now, how do we remember, the accounts which need to be debited? That's a very a simple trick. I'm sharing a simple trick here. Generally, these types of accounts are increased with a debit. Okay, what does it? What are the accounts? Dividends, expenses, assets, and losses. They're all increased with a debit. So we can remember that using a keyword called deal when recalling the accounts that are increased with a debit. So deal here means dividends, expenses, assets, and losses. So when we want to increase it, we debit these type of accounts. Okay. Now, um, again, how do we remember now which accounts need to be credited to increase its value? Generally, the following accounts are credited. No, if we have to increase its value. Gains, income, revenues, liabilities, and stockholders. So we can remember that as girls. Okay. So girls here means gains, income, revenues, liabilities, and stockholders. When we want to increase its value, we credit these accounts. Okay. So this will be a simple, a way to remember if you're new to accounting transactions. So please, try to remember these keywords, deal and girls, whenever you want to understand why this account has been debited or why this account, a particular account has been credited by F&O, journals. Okay. Now, now let me move on to the next, you know, rule. Um, so what are accounts and its normal balance? Okay. So normal balance, what do you mean by normal balance? When looking at an account in general ledger, the following is a debit or credit balance you would normally find. So what does it mean? Okay. Um, Normally a cash account is of a category asset, and by default, it has got a debit balance. Okay. Well, what does it mean? Means that the debit is higher than the credit. That's when it is called a debit balance. If the debit is lesser than the credit, then it is called a credit balance. In this case, you see that, okay, the debit is 1,000, whereas the credit is 1,200. And here we call it as the cash account has got a credit balance. And in this case, we say that the cash account has got a debit balance. By default, debit now asset account should have a debit balance. It means that asset should have increased value. If the asset now value has gone down, okay, then we call it as a credit balance. So again, if these informations, these kind of postings you will find in a balance sheet, okay, uh, account, okay, balance sheet report. So we'll see that, and you'll be able to understand it better when I show you a balance sheet report in F&O. Okay. Now, similarly, there are so many other account categories, and what are its normal balance. A liability should have a normal balance of credit. A owner's equity should have a credit, and expenses should have a debit, and losses should have a debit. Gain should have a credit normal balance. So I just given one example, so you can relate this and then understand what is the normal balance of a debit, of an expense or gains or loss accounts. Okay. Now let me go move on. So now I move on to the reports. Okay. There are two types of reports in a ERP application. Okay. One is called internal reports, and the other one is called external reports. So what's an internal report? An internal report, example of an internal report is a trial balance. What's a trial balance? A trial balance is a report which is generated internally so that you make sure that all your debits and credits are matching. Okay. Once you ensure that it is in balance, then you move on to the next step called the balance sheet. Okay. So the trial balance is used only for your verification to ensure that all your postings are done correctly. If not, you have to make some adjustment entries. Okay. And the objective of the trial balance report is to show you that the amount in each column should sum up to the same total. What do you mean by same total? That the trial balance will have two columns, the debit side and the credit side. Your debit side account, an okay total, should match with the credit side count of your uh, no trial balance. So that's why the concept here is where the concept of the double entry comes in. So double entry means that you're ensuring that you're now um, you're debiting all the accounts correctly, and you're also crediting all the corresponding accounts correctly to make sure that both the debit and credit totals matches. That's what is reported in trial balance. So any ERP accounting software has been programmed automatically to ensure that your debit equals credit, and there is no computing error in that. If there is an error, it means that okay, the trial balance will go out of balance. Okay, should if a trial balance is not in no out of balance, it means that your accounting posting has got some issue. You have to get into drill down and go examine account wise. Each account you have to examine whether the debit matches the credit. So that's why it says that a trial balance should never indicate a difference. If there is a difference, you have to go back, do some correction through adjustment entries, and again generate the trial balance, and note that the total at the bottom of all the debit accounts should match the credit side of the uh, trial balance report. Okay. Now let me move on. So to the next one. This is external reports. Okay. So what's an external report? Example of external reports are financial statements. So what's a financial statement? These are external reports which have to be submitted to your regulatory authority, okay, a tax authority, and it is usually now implemented strictly now followed by a corporate business. Okay. So what are the various types of financial statements? So a balance sheet, a income statement or a profit and loss statement, statement of cash flows, and statement of stockholders' equity. These are all various financial statement. And what does it report? So a balance sheet reports the assets, liabilities, and the equity account balances, and must always comply with the accounting equation A equal to L plus SE that we saw in our earlier slide. And what does the income statement report? It reports the net income. How does it do? It reports the revenues, gains, expenses, and loss, And finally, at the end of the report, you will see that it reports the net income. How is the net income calculated? Net income is equal to revenues minus expenses plus gains minus losses. So this is what is the objective of a income statement. So when you see a income statement and P&L statement in F&O, you should always look at the net income and what is the net income. And the net income is calculated based on all the previous accounts which has been listed in the income statement. Okay, and you arrive the net income using this formula. So the next is a statement of cash flows. So, what does it mean? Statement of cash flows. Again, this is one of the reports in F&O, and you will be able to understand it when you understand what is reported in a cash flow statement. Basically, a cash flow report will always have three sections. One is the operating activities, the investing activities, and finally the financial or financing activities. What does the operating activities contain? No, it has the net income, which is actually pulled out from your P&L statement. What are the income investing activities? It will actually specifically report what was the cash spent and received in transactions involving long-term asset acquisition. Okay. And what is financing activities? If you have to arrange some loans for your business and you record all those activities under financing activities. Okay. And similarly, the statement of stockholders' equity. This is similar to your income statement and statement of cash flows. So I'm not going into the details. This is a little not beyond the scope of our discussion. So I'm going to just focus on a balance sheet, income statement, and because these are the reports which you will be now seeing on and on when you actually generate reports in your F&O implementation activities. Okay, and let me move on. Now, this is the accounting cycle that is followed in a ERP, okay, like F&O. How does it now start? It starts with identifying and analyzing the transaction, and then we create a journal for those transactions, and then we post the journals to the general ledger, and then we generate a unadjusted trial balance. What does that mean? It means that there could be some error in trial balance. This is the first step is called unadjusted trial balance. So you go to the F&O report, you generate trial balance, you make sure that all the reports matches. I mean, when the debit side and credit side matches, and then if there is no match, if it's not matching, we have to prepare a worksheet, and then we have to record some differences. What are the differences? And then prepare some adjusting entries to be posted, and then we have to post the adjusted entries and generate the adjusted trial balance. So then once you do that, then now you start preparing your financial statements that I talked about in my earlier statement. After you prepare your financial statements, you create some closing entries, and then you post those closing entries. So this is the general accounting cycle followed in any business, and the same is implemented in F&O as well. So with this, I stop here, and I will what I do is I'll now take you through some examples in my next session. Until then, stay tuned. Feel free to add your comments, and please subscribe to my channel if you're interested. And I look forward to meeting you all in my next session with some examples of accounting in real life business scenarios, and then related to how F&O implements that. Thank you all. See you soon. Bye.